how do you account for a piece of another company? Is it a passive ticket held in a vault, or an active extension of operations? Standard accounting texts point to a specific benchmark. Owning between 20 and 50% of a company's voting stock triggers the equity method. The numerical distinction between a 19.9% stake and a 20% stake disappears if the underlying reality proves you call the shots. The actual trigger is significant influence. This is the power to participate in the financial and operating policy decisions of the investee. This follows the principle of substance over form, where economic reality takes precedence over legal technicalities. Once you achieve significant influence, your accounting must reflect it. You treat the investment almost as if it were a subsidiary, collapsing its operational successes and failures into a single line on your balance sheet. True influence is measured by power dynamics and operational reality on the ground, regardless of the paper percentages. To identify significant influence without relying on the ownership percentage, auditors look for 5 distinct behavioral indicators. The first is representation on the board of directors. A seat at the table grants you a direct voice in corporate governance. The second is participation in policy-making processes. This includes having a say in decisions about dividends or other major cash distributions. Third is material intra-entity transactions. Heavy buying and selling between the two companies binds their economic fates together. Fourth is the interchange of managerial personnel. When executives swap desks across companies, operational control flows with them. And fifth is technological dependency, or the provision of essential technical information from one entity to the other. Board exams often focus on this specific detail. A 15% owner who exhibits these indicators is still required to apply the equity method. Ignoring these behavioral signs means the balance sheet fails to capture the true, intertwined economic relationship of the entities. Under the equity method, the investment account does not sit permanently frozen. It acts as a breathing asset. Step 1 is initial measurement. You record the investment at cost, which includes the transaction price plus any direct transaction costs. Looking at this excerpt from ASC 323-10, paragraph 35-4, establishes the legal requirement. An investor shall recognize its share of the earnings or losses of an investee in the periods for which they are reported. This creates Step 2, the growth mechanic. As the investee reports net income, the investor's carrying amount physically grows. In passive fair value accounting, an asset fluctuates based on external market prices. Here, the asset reacts directly to internal performance. The math involves multiplying your ownership percentage by the investee's reported net income to find your share. This dynamic is referred to as a one-line consolidation. It mirrors the process of fully absorbing a subsidiary, but collapses all that operational detail into a single asset line item. The investor's balance sheet physically inflates in direct tandem with the operational success of the investee. But there is a primary complication to that basic math. Your ownership percentage only applies to the common equity claim of the investee. You must apply the preference dividend shield, which acts as an absolute ceiling on the net income actually available to you. Preference shares hold a prior right in the corporate hierarchy. Their dividends must be carved out before common shareholders can access a single dollar of income. The accounting rule depends on how those preference shares are classified, splitting into 2 distinct paths, cumulative versus non-cumulative. For cumulative preference shares, the rule is unyielding. You must deduct the annual preference dividend from net income, whether the board has declared it or not. The logic follows the legal structure. Cumulative dividends accrue by law. They permanently reduce the net assets available to common shareholders every single year, regardless of any board action. Conversely, for non-cumulative preference shares, you deduct those dividends only when they are explicitly declared by the board. If left undeclared, a non-cumulative claim simply evaporates at the end of the year, leaving the net assets entirely intact for the common shareholders. Direct instructive tone. Missing the distinction between share types leads to systematic errors in multi-year audit problems. Failing to apply the preference dividend shield results in artificially inflating your asset value far beyond your true economic claim. Receiving a cash check feels intuitively like generating income, but under the equity method, accounting treats it as destruction. If you were using the fair value method, your instinct would be correct. A dividend check would directly hit your income statement as revenue. The economic reality dictated by PAS 28 and ASC 323 is different. A cash dividend is simply a return of your own capital. It is not new wealth generation. When the investee pays out a cash dividend, cash leaves their balance sheet. Their total net assets shrink. Because the investee's net assets just shrank, your breathing T account must simultaneously shrink to match. You credit the investment account to reflect the extraction. There is one exception to this shrinkage rule. Share dividends, or pro rata distributions of stock, do not reduce the investee's overall net assets. No cash leaves the company. Therefore, no formal journal entry is required. You only make a memo entry to adjust your per-share cost basis, because the exact same economic pie has just been cut into more slices. Under the equity method, cash dividends are merely an extraction of the value you already recognized during the growth phase. Let's lock these core spatial mechanics into a clear memory map for long-term retention on your board exams. Rule 1. Influence is fundamentally greater than percentage. The 20 to 50% range is merely a presumption. Any of the 5 behavioral indicators, like board representation or policy participation, will override that number. Rule 2. The asset breathes. Investee net income physically increases the asset. Cash dividends physically decrease the asset. Rule 3. The preference carve-out. You must strip cumulative preference dividends from net income before applying your ownership percentage. Mastering this spatial mapping strategy bypasses the need for rote memorization of journal entries. Visually recalling the physical expansion and contraction of that T account will prevent you from freezing when faced with complex, multi-year audit problems. The equity method provides a living, breathing reflection of operational power and corporate reality.